What's going on, guys? MMuniz here. Welcome back to the channel. You may notice that the video looks a little bit different, and that's only because I came across some technical difficulties when I was making this video. So with that being said, the show must go on. Here we are. But this video today is going to be about the income ETF DIVO, or I like to call it DIVO. Now, we're going to give a quick breakdown of the fund. We're going to talk about its holdings, its strategy, and then we're going to talk about how it compares to other income ETFs, because surprisingly, even though in my eyes, this fund should be a top pick for everybody, whether you're in retirement or even if you're leading up to retirement, it's actually not that popular when you compare it to QYLD or JEPI and those other funds. So we'll see how it's performed. We'll also compare it to the S&P 500. And then lastly, we're going to talk about where I think it's going in 2023 and beyond. Just a quick note. I do own shares of DIVO. I bought it back in 2020, and I continue to dollar cost average on a monthly basis. It's a very small portion of my portfolio, but I do really like the fund, so you may find me a little bit biased. At the end of the day, this video is not financial advice. It's up to you guys to do your own research and determine what's best for you and your family. With that being said, I hope you stick around and let's get right into it. So first things first, what makes DIVO DIVO? Why is it the exchange traded fund that I like so much? Well, to start things off, it's an actively managed fund that holds around 25 large cap, high value, dividend paying companies. And not just that, but they look for companies that are growing their dividends. So you're going to see some dividend aristocrats in here. Now, not everyone's going to want an actively managed fund, and that's completely okay. I personally like a mix of both passive and actively managed because I like to diversify my portfolio. And I think DIVO offers a great strategy that its managers, Capital Wealth Planning, do their best to replicate. So that strategy, what exactly is it? Well, DIVO seeks to give you a minimal volatility fund that still allows growth over time. So you are going to see capital appreciation with this. And if we look at the history of this fund from its inception date, it has grown its net asset value. That being said, the reason we're here is because we talk about income ETFs. So when it comes to the income that this fund is going to provide, it's going to be on a monthly basis, and it's going to be in two forms, although it is combined. That's going to be dividends from the companies it holds, and it's also going to be options premiums from the covered call options that it writes. Now, one thing about those covered call options is it's going to differ from those passively managed funds like your QYLDs, for instance. And the reason for that is it doesn't write covered calls on the entire portfolio. It only writes it on a couple strategically picked stocks. What the fund managers look for are increased periods of volatility for certain sectors or certain stocks, and that's what it chooses to write its options on. So it tries to be the most strategic when it comes to that. A good example of how something like this could be better than QYLD, for instance, is a lot of people may think that the market is reaching a bottom and may start to increase soon. With QYLD constantly writing covered calls on its entire portfolio, there's no real strategy there. They're not going to be able to take advantage of the upswing, whereas something like DIVO still can take advantage of that, which is awesome. So basically, you're getting a monthly paying dividend stock that's going to give you increased dividends because of the options premiums, and you don't have to worry about your capital decaying over time. Ideally, this capital should grow over time like it has in the past. Another quick thing to mention is its expense ratio. Even though it's actively managed, it is lower than the global X ETFs that we talk about. It's going to be 0.55, which is $55 out of every $10,000 invested. Another thing that DIVO does really well is it doesn't let certain companies within its portfolio take over 8% when it comes to their entire holdings. Also, the sectors they like to keep below 25%. So when we scroll down a little bit, we're going to see a pretty good balance of the sectors that DIVO holds and also its companies. Now, when we actually look at its holdings, these are going to be really common names that you guys know about. Home Depot. Everybody knows Home Depot. McDonald's, Johnson & Johnson, Visa. The only thing that's a little interesting to me is, they're in the energy sector. They have Chevron. I guess to me, if we're looking for high value, large cap stocks that offer dividends, I just wonder why they don't have Exxon in here instead. When we compare Exxon to Chevron, Exxon is ranked higher on the Fortune 500. It has around $100 billion more when it comes to market cap. It pays a higher dividend. It's grown more in the past. The list goes on and on when it comes to Exxon. Chevron, great company, but Exxon is clearly the winner in every way that I can think of. But then again, I'm just your average Joe, so what do I know? Either way, we have around 25 companies. You can even see the options that it currently has. It's got one on General Mills, it's got one on Merck & Company, and it even has one on Duke Energy, the utility company. All of these expire in January of 2023. So now that we've given a quick breakdown of the fund, how has it actually performed? Is that strategy where it's providing dividends and options premiums in addition to allowing potential capital appreciation? Is it actually working out in the current market? If you had invested $15,000 back at the beginning of 2022, where would you be now compared to some other options? Let's take a look. So we're going to take a quick look at Portfolio Visualizer, which is a pretty cool tool that everyone has access to. And we're going to look at if you had invested in the beginning of the year. Now, we're going to compare DIVO to JEPI since that's probably the most popular income ETF right now. We're also going to look at QQQ, and then we're going to compare it to your standard S&P 500 investor. So if we had put $15,000 in, where would we be? Now, this is going to be with dividends reinvested, but right off the bat, this year alone, DIVO is the clear winner. And it's pretty easy to figure this out why. Obviously, if you have a fund with only a few large cap, high value, low volatility stocks, typically in a downward market, those should not go down as much. So that's exactly what DIVO does. Now, JEPI and your S&P 500, they're also large cap stocks as well, but there's a lot more. There's a lot more diversification. And diversification can go both ways. Typically, yes, it's going to help you in periods of volatility. But if you're just comparing it to something that has minimal volatility, if everything else is going down, then it's going to underperform. And that's what we're seeing here. So it does make sense. The worst performer is going to be QQQ. There's no surprises here. In an environment where interest rates are going up on a monthly or bi-monthly basis due to the Federal Reserve, growth companies are suffering. Growth companies are having to lay off. They're not able to invest as much money because it's more expensive to borrow money. When that happens, investors pull their money out and they seek value elsewhere. So compared to everything, QQQ is just down drastically. Now, if we go back 5 years, then QQQ would still be doing better than these, but its returns have come a lot closer to just your average S&P 500 return. So of all of these, if you had invested in the beginning of 2022, right at the peak of the market, technically it was November 2021, you'd actually be up by 1.15%, which is pretty crazy considering almost everything, everyone's portfolios are being destroyed right now. That being said, we also have some pretty good income. If we look at how much money the dividends were paid out, JEPI is going to be the highest. JEPI does typically pay out around 8%, whereas DIVO only pays around 4.5 to 5% on average. So if you had not been reinvesting your dividends, you would have received this amount of income you can see here. But at the end of the day, for total returns, DIVO was the number one pick. Now let's just take a quick look. What if 2022 was a straight down market. So this is showing us that DIVO performs well in a down market, which with its strategy makes sense. But what about if we include 2021? So technically we went up a lot and then we went down. So, if you go over those 2 years, you could technically say it was a flat market. Very similar story. DIVO still outperformed. And this makes sense as well. When you have high value companies that are paying dividends and then you're also gaining from your options premiums, you should be doing pretty well in a flat market. Whether it's going up or down, you're able to participate in both of those. Not as much up, but also not as much down. So we have seen quite a drop off, and that's why DIVO is still doing the best. What about since 2020? So a lot has happened in the market since 2020. Growth stocks skyrocketed. Your S&P 500 did really well. There was the massive crash of COVID. How did it do? Well, this is where, like I said before, QQQ actually does still take over. With the massive amount of returns that QQQ received because of the drop in interest rates down to basically zero, it's really hard to wipe away all that growth, even with the massive decline that we've been seeing. But at the end of the day, you got to ask yourself a question. With QQQ having the massive run-up that it did, just like something like Tesla, do you really think that that's going to happen again? A lot of people do. I personally don't. I think that it's going to outperform long-term because that's what growth is. I mean, you're investing in technology. Technology is meant to change the world, so ideally, that's what should happen. But I think that that's a hard bet to make, and that's why those investments are a little bit more risky. With something like DIVO, you're minimizing your risk. You're still getting a nice monthly return. And even in massive bear markets like we're seeing now, DIVO's still doing pretty good. So my personal opinion is whether you need the income now or you're still saving for retirement, it doesn't really matter. DIVO can be a decent addition to anybody's portfolio. Now, I'm not saying go buy all of it. Keep it to a small allocation to make sure your portfolio is diversified. Take advantage of multiple ways of making passive income to better preserve and grow your wealth. That's what I'm doing. Is it working out in 2022 right now? Not really, but luckily I'm still young. We're going to keep dollar cost averaging, and over time, I know that it's going to work out. So I want to know from you guys, what do you guys think? Are you surprised that DIVO outperformed pretty much everything in the past couple years? I kind of was, although I shouldn't have been, because when I learned about the strategy of the fund, I immediately bought it because I just figured this is going to be a great fund long term. So leave it in the comments down below. I do my best to answer all comments on all of my videos. And with that being said, if you haven't already, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to personal finance or fitness. Thanks for sticking around. I hope you guys have a great week. Take care.